All right, friends, welcome back. Last week we had a big event that happened in the markets, the Jackson Hole Symposium, and is where the Federal Reserve Chairman Jerome Powell actually sent us a signal. So this video is to share with you what's next for the markets and what are you missing from what the headlines have been saying. Now, before we begin, if you haven't done so already, I would really appreciate it if you could hit the like and subscribe button. It will really help me to keep making these videos for you. Okay, now let's get started. So last week, what actually happened is this event called the Jackson Hole Economic Symposium. So this is an annual central banking conference in Wyoming in the United States. So in this central banking conference, right, there's a lot of big economies that will come to this event, and one of the biggest guy is actually Jerome Powell, lah, okay, the federal chair that actually attended, and the whole world, in fact, the market is actually looking at what he is going to say in this economic symposium every single year, right? Everyone was looking forward to what he says about the monetary policy because that affects the world. Okay, so what did he say? Now, before understanding what did he say, right, I want to share with you what is the objective and the goal of the Federal Reserve. So the goal of the Federal Reserve, right, is two main things. Okay, what do they aim to do? Number one, they call this the dual mandate. Now, the first thing that they aim is for maximum employment. So what does this mean? That means that they are targeting an unemployment rate of 3.5 to 4.5% in the country United States. Okay, so they want to achieve that, and they say is within this range, right? Unemployment is still acceptable, and right now unemployment is at 4.2%. So you can see it's still within the range, just that it's just slightly closer to the higher side, but still within range lah. Okay, and the second one is what we call price stability. So this is basically inflation. So you can see that what they say is they want to have a target inflation rate that over time averages 2%. Okay, but right now, inflation, which is measured by the core CPI, is at 2.9% right now. So you can see it is well above the target right now. So this is the thing that they aim for. So you can see that they are playing this balancing beam, okay, of managing maximum employment and price stability. Okay, and one more thing that they do is what they call the lender of last resort. Okay, what does lender of last resort means? This basically means that if let's say there is a bank where they cannot kind of like return money to people, right? They don't have enough cash. What the Federal Reserve can do is they can give them credit. Okay, they can give them lend them money lah, basically. And how do they do that? By printing money. Okay, so that's how they can do it, lender of last resort. If let's say a bank suddenly needs saving lah, but this is like the worst case scenario lah, which we hope you don't see it happening lah. So what is the key indicator that they look at to achieve these two dual mandate, right? So I've run through this before, but the four main things are inflation, economic growth, employment, and business activity. So inflation, right, how they measure is through the consumer price index and the personal consumption expenditure. There's also one more, which is the PPI. Okay, even though PPI can be measured from the personal consumption expenditure, but they do look at it as a holistic picture to measure inflation. The other one is employment rate, which is measured through the non-farm payroll as well as the unemployment rate lah. Straightforward. Now, economic growth and business activity, right, they are also taken into account when the Fed consider whether to do a rate cut, rate increase, or maintain the rates lah. But the economic growth and business activity indirectly also factors into inflation and employment lah, right? Because if GDP is growing very well, that means that people are spending ma. People are spending means what? Potentially it will affect inflation going up. So business activity as well, right? When business activity increase means what? That means there's a lot of demand, right? A lot of demand for goods. Consumer are spending more, and business will have to hire more, right? And produce more goods, right? So that means it also affects employment. So it all goes back to inflation and employment still, but they look at this as a whole picture lah before they make a decision. Now, so what actually happened last Friday? What is the exact words that he said, guys? So the exact words that he said, which actually shifted the whole market, which caused the market rally. One single sentence, guys, caused the market rally, which is this. With policy in restrictive territory, the baseline outlook and the shifting balance of risk may warrant adjusting our policy stance. Now, this is the word here. May warrant adjusting our policy stance. So how did the market see it? Basically, right, the market sees it as, oh, Powell is going to do a rate cut. This is how they see, even though he said may warrant. Guys, the keyword is may warrant. It's not will warrant. The words are very, very important over here. So a bit of wordplay over here. So this is what he said. So why did the market rally? Why did this single thing that he said, right, cause the market to rally right now. Let's go back to this chart, which is, I think, something I shared before, but let's do a very quick recap, right? So what happens to stock prices when the rates rise or fall? So let's talk about interest rate rising first. When interest rate rises, right, this means that cost of borrowing will increase, right? Because it is more expensive for business to borrow. And when it's more expensive for businesses to borrow, that means they got lesser money to invest into the business. Lesser money to invest in their business means what? Means that they cannot do a lot of marketing and things like that, right? Which means consumer spending will drop. And when consumer spending drop, this might affect the revenue and profits of the business. That is why the stock market will drop, right? So this is when interest rate increase. And if you think from a consumer perspective like me and you, right? When interest rate increase, that means if you put our money inside the bank, like DBS, UOB, right, we get more money, right? So we will tend to try and save more rather than spend more because putting money in the bank can get us good interest rate. Now, on the other hand, if interest rate drops, okay, from a business perspective, right, borrowing is going to get cheaper. They can borrow more money. And when they can borrow money means what? They can invest more into their business. Invest more in their business, more sales and marketing, more goods, okay, more innovation, more R&D means what? Consumer spending will increase lah, right? Because consumer got more money. And also for consumer, right, if you think, now putting into the bank will get me lesser money. So what do? I take out money lah. I take out my money and I put somewhere else. Maybe I put into slightly risky assets, or if my business is doing well, I have a job, I can afford to spend more, right? So that's why consumer spending will increase. So all this then flows back to the business, right? Profits, revenue might increase. So that's why you can see the stock market actually rally, which is this portion over here lah. What the Fed signify, which then caused the market to rally over here. Now you can see that this percent, this is a chart of the probability of a September rate cut. So you can see from June, right, from 68%, and then when the Fed met in July, it actually dropped to 38%. Okay, and after that, what happened? Just 1-2 weeks later, because of the results coming out, and also don't forget Trump is pressuring the Federal Reserve. You can see that July payroll, the rate cut percentage increased to 80%. And even after the CPI in July, it went up to 100%. That means the market believed that the Federal Reserve 100% will cut rates. Okay, but then there came a bit of a shocker, which is the PPI. Okay, the purchasing, what is the PPI? Is the producer price index, which actually shocked the market because it shows that actually there is inflation on the producer side. Haven't go to consumer, but it's at the producer side. And then it caused the rate cut probability to drop. And then after that, it dropped further a little bit again at this point. And after Powell speak, right, went back up to 85%. So you can see how, in a way, positive the market took it in terms of what Powell said. Now, we all know that he said that one single sentence, right? But the question is that one single sentence everything there is to it or not, right? Did he say more than just that sentence which you can take away, like what all the media say? Cannot be, right? Because there was a whole speech. How come the media only fixate on that one sentence? So what I did was actually I went to really look at his full script. I went to dig exactly what he said, and I pick out 3 key points that I think that for all of us as investors, it's very important for us to know, to have a full picture rather than only focusing on what the medias are saying. So 3 key things. So I've run through everything, and the 3 main points. The first one is tariffs. Okay, so there's a lot of words here, but I want to bring your attention to a few things. The first one is this. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of ongoing inflation problem. And another one, what he said, he followed up, the effects will be relatively short-lived, a one-time shift in price level. Okay, what does he mean by this? So basically what he's saying is that for tariffs, right, it will only increase the price one time, a single time. Why? Because if let's say goods are coming in, you only tax them, you tariff it once, and then the price increase will flow to the consumer for one time. And that's all. That's what the Federal Reserve is believing that it will happen, that this increase will be a one-time increase and it will not be an ongoing inflation problem. That means he believed that, it's not because of tariffs, right? Suddenly price will keep getting higher and higher over the next few quarters. It will only increase once and that's all. So you can see that the question, so he said it's unknown, but he said that whether this price increase will materially raise the risk. Because if he's wrong and inflation keeps getting higher and higher because of this tariff, right? Then it's going to be a problem, right? Because you see, his mandate was what? To maintain at 2%, and we're already at 2.9%. So if the tariffs makes it higher and higher, right, it's going to be a problem. But what he say is that he's believe that base case, it will be short-lived. It will just be a one-time increase. So this is like, in a way, the stance that he's taking right now. So this is the first thing. The second thing is this, what we call flexible inflation targeting. Okay, so the first paragraph again is more of the technicals, but look at it. The main thing is here. We return to a framework of flexible inflation targeting and eliminate the makeup strategy. And he said that the idea of an intentional moderate inflation overshoot has proved irrelevant. Now, how do we understand this? I want to bring you guys back to 2020 when COVID happened. So what happened in COVID 2020 is that from the month of July until Jan 2022, that means for 1.5 years, interest rate was 0%, guys. That means you all can imagine, just now you all saw the chart, right? That what does interest rate 0% means? It means that borrowing money was so cheap, right? It was so cheap, businesses could spend so much. That's why you see 2020 onwards, the market rally like crazy. Okay, and what happened to inflation, right? Because again, money so cheap and everyone got stimulus check, right? All of us got a lot of money. What happened to inflation, right? Remember, the base case was how much? 2%, right? But what happened? It ran all the way up, no, until here. And then what did the Fed say? The Fed say that on July 2021, inflation is expected to drop. Okay, at this point. Then actually not then that didn't happen. It went up even higher. And June 2022, he said inflation has again surprised us to the upside. And you can see, when did the Federal Reserve only take action? They only take action at this point. Okay? They only take action at this point. And if you draw the line up, only when inflation is close to 8%, and then they started to take action and they increase the rates. Okay, so this is what they mean by earlier that they do this flexible policy and they do this makeup strategy, which means they will purposely let inflation to run up very, very high first. Then they come in later and they go and fix it. Okay, so it's like kind of like they offset it lah. It's kind of like a wait and see, like a very reactive rather than being a proactive stance. So this was what they did before, and then after that you can see that what actually happened after they slowly increase every single quarter. Then you can see everything, which is the stock market as well, everything just tanked right away lah. Okay, so what the Federal Reserve is saying is that this thing that we did back in 2020, right, it will not work anymore right now. So instead, right, what they are saying is that they will do this policy, right, where they will play around and ensure that this number, which represents inflation, will always maintain at 2%. So this means, right, they are becoming a bit more proactive. They monitor straight away. So to visualize, to help you with this analogy, imagine a room, okay, that is hot and cold. So what he's saying is that if the room, last time his policy is the room gets too hot, they wait until the room gets very, very, very hot first. Then they start to change the temperature to make the room cold and bring down the temperature. Okay, the temperature means inflation. They wait until very, very hot first. Then they turn the temperature lower. But right now, what they are doing is what? They say that, I don't want to wait until it becomes very hot, or I don't want to wait until it becomes very cold. I want to make sure that no matter what, I am constantly adjusting the temperature such that it is within the acceptable range. That means you see, they're playing around very, very closely. They are watching it very, very closely. So this is what they are doing to do right now. That change lah. Okay, but whether it's good or not, we will have to see lah. But at the very least, it meets their dual mandate plan as well. Okay, now before I move on to the third point, the last key point is that if you don't know already, I have a Telegram channel filled with a lot of personal market insights, real-time macro trends updates like what you see. So I update it even more frequently in this channel, and also investing knowledge and lessons that I've learned over the years. And of course, on and off, you can see videos of me rambling about life lah. Okay, so it's free to join, guys. So feel free to pause this video and you can scan this QR code to join, or alternatively, you can just join directly from the link in the description box down below as well. Okay, now let's move on to the third one, challenges to the dual mandate. Okay, so you all saw the dual mandate we saw earlier. So what did he say? Important, inflations are tilted to the upside and risk to employment to the downside. So this is what you saw, right? You can see inflation is very high right now, 2.9 instead of the 2% target. And employment rate is still within the range. It's not very high, but still within their range that they accepted. And they say it's a challenging situation. But I want to bring you guys to this important word. Monetary policy is not on a preset course. Okay, this is important. What does this mean? That means he is not confirmed that he will do the rate cuts. He didn't confirm that. He only say what in the earlier thing that you say. He may warrant a policy cut. May warrant is not means I will confirm cut. Okay, so this, what he said, is that he opened the door to cut in September. But that's all that it was. Now, I look back at the 2024 Jackson Hole speech and what he said. And you all see the difference. 2024, right, you can see. He said very, very explicitly, the time has come for policy to adjust. It was very clear. Straight he said that, okay, it's time for me to go and adjust the policy right now. Okay, he said it straight away. It is more direct and very, very clear. That is very different from saying that a policy adjustment may be warranted. Okay, so it's two different things. So even though the whole market is expecting them to rate cuts, and even though I think yes, he will probably bring the rate cuts because it seems like he is leaning more towards like, okay, I need to play the balancing game and doing the rate cut, and because tariff is only a one-time impact, it should be okay. But it's not still a confirm. He didn't actually confirm it, because it's still a bit uncertain ahead. And this is not a signal that the September cut is the beginning. So how do we look at it as a whole? Okay, the first one is this. A rate cut looks likely, but is far from guaranteed. Okay, and even if it happens, this should not be seen as the start of a new easing cycle. Okay, so this one is actually typo here 2020. Okay, that means he was saying that, hey, it doesn't mean you are going to see a rate cut that's going to drop drastically. Okay, so take note of this. The last one is the Fed remains highly data dependent. So the when are they going to talk about the rate cuts is in September 19. It's in 3 weeks later, like not immediately. It has not been done yet. So they are still looking at the upcoming data for them to have a clearer picture. And so what is the thing that they're looking at? Okay, so this week there isn't anything, but what they are looking at is this employment. Anything that says employment one, they'll be looking at. These are the things that we'll be looking at for next week. And the following week, even before that thing happens, right, is they also be looking at the PPI and CPI, which is inflation, as well as unemployment claim. Okay, so these are the things that we're monitoring. So I'll be monitoring as well. And these are the things that I believe all the whole market will also be looking at it as well. Okay, so we have to know, because if these things change, the rate cut might not happen as well. So and when that happens, right, that might actually the market might react accordingly. Okay, so that's all. I hope that you have learned something here today on what to look out for, and also what to focus on, and having that full picture rather than just what the media is saying. Now, before that, right, before we end, right, I would just like to invite all of you to connect with me. Okay, follow me on TikTok, on Facebook, or YouTube as well. So which is this channel. So I share a lot of videos on TikTok. Facebook, I also share a lot of insights and knowledge as well. So follow me. Okay, basically you receive a lot of prompt updates as well. I would love to connect with all of you. Do drop me a message, say hi. I'll be more than happy to chat with you guys. Okay, so that's all. I hope you have enjoyed the video, and I'll see you again next week for another video.